This episode begins with the story of T.M. Chang, an immigrant entrepreneur whose granddaughter, Kristina, now helps steward the family's capital at Westlake International. Westlake is a diversified, multi-generational family enterprise anchored by a global family office investing across private equity, real assets, and long-term strategic holdings. The family's journey traces from scarcity in post-war China and Japan to the disciplined act of saving capital one pickle jar at a time. Kristina, thank you so much for being on the show. Really appreciate you taking the time. I know you are very busy with a lot of different deals across a variety of industries. But before we jump into Westlake, I really would love to spend a few minutes to learn about your family's story. And it's such an amazing story. It's a story of immigrants coming into this country, which I can relate to as a first-generation American. But really, so many amazing facts, lessons that can be teased out of it. Would you mind just sharing and starting at the beginning with your grandfather?
Of course, and I think that's where the story of Westlake really begins, is with my grandfather. So my grandfather was the first generation of our family to live on land, actually. So they're from Ningpo, which is an area of China outside of Shanghai. And prior to my great grandfather, we were basically like homeless people. So homeless people go up and they live on like boats. I think they're called like yunkers, going up and down the Yangtze River. And my great grandfather bought a plot of land and he was a farmer. And that was like a big socioeconomic leap for my family. And then he had 12 children, which is a lot. I mean, I think most of us struggle with like one or two these days. Um,
No, I have five. That seems like 12. I can't even imagine.
that's over double your
Yeah.
workload. So
And what year was this roughly, Kristina, just from a time?
this is my grandfather was born in the 1920s.
Okay.
And so he was the first generation in his family to live on land. They went to school, so he learned to read and write. And then my great grandfather pulled him from school as soon as he could read or write, because we didn't have money or resources. Like, we needed people to be working the land. And then after World War II, they sent him off to Japan with 2 vats of pickles that got stolen on his way from northern China all the way to Japan. And so he showed up, it literally had nothing. So he's like washing dishes, doing whatever odd jobs and manual labor that he could. And he just didn't want to do that forever. So he started teaching himself Japanese. And yeah, because mind you, like, he shows up and he doesn't speak a word of Japanese,
Amazing.
and teaches himself the language. He ends up getting a job as a farmer rep for a European pharmaceutical company. I don't know how. The legend is that he wrote over 200 letters, but who knows? I mean, he gets himself a job at a farm as a farmer rep, works himself up, and gets to the place where he's running Asia Pacific for Sharing Clow, and he's got his own company with a bunch of reps in it.
And how old is he now at this point in time? Is
40s. This is happening. The wealth generation is happening in his 30s and 40s, which
Got
is
it.
crazy because like he didn't start our family business until 1972. And so in the early 70s, he sees kind of stagnation going in the Japanese economy, and he moves to the US, teaches himself English, reading the IRS tax code. And he's in Silicon Valley, and he's like, wow, there's so much innovation and great things happening here. But it's not that tax efficient to invest in early stage companies. So maybe we should invest in the real estate underneath it.
I
And
just want to go back to what you said. So he taught himself English reading the IRS code.
yeah, and if you do that, you're going to invest in real estate. You won't invest in early stage startups.
So multiple ancillary benefits beyond learning the language, but it shows incredible commitment. It shows perseverance, right? I mean, today people have, all kinds of fancy online learning tools. I can't imagine today that kind of commitment you just don't see if literally studying IRS code.
I know I'm a lifelong learner myself. I taught myself Spanish on Duolingo like 3 or 4 years ago during COVID. But Duolingo makes it a lot easier than the IRS tax code.
Incredible, incredible. Okay, so he's entrepreneurial. He moves from country to country. He has an eye for business opportunity. He can spot both growth and he can spot a negativity in economies, and he's constantly adapting
Yeah,
and
I
learning.
mean, he was just a value creator, and I think one of your questions talked about kind of value creation, and or what happens when you're not in that immigrant mentality anymore. Um, I think it comes down to a mindset of value creation, and you go somewhere new and you know that there's no backup plan. I have to create value myself, and I have to figure out a way to do it different and better than the person sitting next to me. And that is a big part of our family culture and the fabric of who we are, and a lot of that comes from my grandfather.
And how do you keep that, Christina? Because I came to America to play tennis, right, on a tennis scholarship, and multiple times in my life when I've tackled a difficult challenge, I intentionally try to metaphorically burn all the boats, right? So there's no retreat, and I think that is a very, very important mindset that ripples through how you execute. But how do you maintain that, right? How is that? Because it's so easy when you come into wealth, when you come into success, to lose that. But how has your family maintained that?
I think for my family's in a particular situation, like, if I'm speaking about, like, my sisters and I and our generation, because 'cause we're the 3rd generation. My when my parents got married, my parents both had family businesses that were about the same size. And my mom's family business, they made a few bad investments, and that has kind of disappeared. I mean, it exists in its shell form, but it was a material amount of wealth loss. And so I know that you can lose it, with a few bad decisions in a very short amount of time. And so I think about being a long-term steward as not just like here to keep the status quo. Wealth needs to be created every generation for the family to maintain where it is. And I don't know, I was just kind of raised with that mentality, and not only just wanting to create wealth for my family, but also being stewards in the communities that we're in. And if I think about friends that run other family businesses who are very motivated and are multi-generational, a lot of it has to do with not only contributing to the wealth of your own family, but being a good steward within your community. And I think those are both very motivating factors when you put them together.
Yeah, I think that's amazing. Sort of how you define, the ripples of hard work, the ripples of value, how you define community, how you define family, more broadly speaking. And for me as a first generation American, I will tell you that I'm motivated by, and I certainly don't get it right. I get it wrong more than I get it right. But making a difference in the country that you're in, making a difference in the community that you're in, I think is something that I try not to lose.
Yeah, and I think that's something that when I think about parenting, and my daughter is very young, so right now she only has one chore a day, um and we haven't gotten to the point where we're doing philanthropy together yet. Um but it's really important to teach that that kind of sense of, even within the household, that there's a responsibility for everybody to pitch in. And I think my parents did a really good job of that, with chores and with philanthropy growing up. And I think those are the two pillars of kind of understanding where you are relative to this your nuclear family and then the community that you live in.
And then how is your family across now 3 generations? How have you used story, right? How have you used the lessons of your grandfather, the story about the pickle jar, the story about him being so entrepreneurial, moving to new geographies? How have you used story to uh, echo and amplify the values that you live by?
I mean, I think it's also the mentality that we view the business as a way to transfer the family values from generation to generation. If you're doing a good job with the transference of family values and you good or decent values, then I think the wealth will create itself. Like, you will have enough opportunities and enough people seeing enough trends in what's going on in the world to create value and to create interesting businesses from generation to generation.
And how, if you had to compare, because I know you have a lot of experience in private equity, you've invested across a variety of asset classes, but when you look at families investing, whether it's your family or others, right? and you had to contrast that to call it more institutional mindsets. The name of this podcast is The Long View: Families Investing at the Speed of Patience, right? And I firmly believe that families that ascribe to those values, that execute those in the investee companies they partner with, is materially different than call it certain institutions that may be looking at it, whether it's quarter to quarter or a short multi-year cycle. But maybe talk a little bit about that and how you think families as an asset class uh, differentiate from others.
And that's a really interesting question. And when I've built new businesses and investment thesis within our real estate platform, I'm always thinking about where is our competitive advantage as a family that has 5 decades of experience doing this, but we can't write the billion-dollar checks that an institution can write. And so that's really that question is top of mind with value creation. I think family businesses can come in a few different ways, and in that sub institutionally sized deal range, at least for us, we see that there's advantages because we can take the brunt of our balance sheet, put things on our balance sheet, and then get financing afterwards and use our cost of capital as an advantage in that space relative to much larger acquisitions where that's more difficult. And so I think about it in terms of what is the cost of capital? Where is our expertise? And then flexible hold periods is the obvious one. Like we don't have to be in and out in a certain time frame. We're here to maximize wealth and to maximize investment outcomes for ourselves and the other families that invest in real estate deals with us.
Right, interesting. And what type of a time frame? Realizing all deals are different, opportunities are different, but talk a little bit about how you think about time when you invest.
I mean, we underwrite to a typical hold time frame, 4 to 6 years. I mean, that's I think what most real estate people do. I mean, some of them are like 7 years or 3 years or shorter or whatever. But we think about it in terms of a pretty typical hold period for all of our new industrial deals. And that allows us to go in and do a value add business plan. We go in, we bump up the rents, and we maybe let those leases roll again. Or in shorter periods, we're waiting it out 2 or 3 years for the lease to roll, and then um, we're signing new leases at market rents, and then selling the properties. But so with some of our longer private equity holds, that hold period can be closer to a decade. It just gives us flexibility. And I think that's where the family office advantage is investing with patience, is having the flexibility to wait for however long it's going to take to execute the business plan. And sometimes that's standard and it fits in an institutional box, and sometimes it's not.
Yeah, I cannot agree more. Talk a little bit about how you look at, call it private equity best practices or institutional best practices, and how you have incorporated, whether it's on the underwrite, whether it's the value creation plan, whether it's mapping exits or recaps. How do you look at institutions? How do you learn from them? Love to get your thoughts.
I mean, I think that institutions, like the rigor that they put into their underwriting is definitely the same as the rigor that we put in. And I think that's really changed in the family office community. And definitely at our company, like we look at every investment from that institutional lens. But I think the more important evolution that's happened is that family offices have been able to use AI, at least in the last few years, to 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 have that kind of um, sophistication and like be able to get through more diligence like an institution would, even though we are smaller players. And so I mean, I guess to answer your question, we go through the same investment rigor that I think an institution would, both on the real estate side of things and on the non-real estate side of things.
Got it. And as it relates to your team that you currently have, and I'd love to get back to AI a little bit later on, but maybe talk a little bit about just what does the team look like? How do you skill sets you have in house? How you partner with third party outsourced, resource providers, whether it's consulting, advisory, you name it.
Yeah, I think the family office community is very split on where where the numbers make sense from an AUM perspective before everything should be in house versus out of house. Um, but because we have an operating business, we're fully vertically integrated. We've got property management, accounting in house for the real estate side of things. Um, we've been able to in-house a lot of the family office services. So we work with a consultant um, who kind of supplements the family office services, but for the most part, I would say that we're like what they call an embedded family office, where we have a few employees who are dedicated to the family office services and trust accounting and all the things that sit on top of our real estate operating business. So my business partner came from Carmel Partners, which is a very well respected real estate private equity firm in the Bay Area. And our head of acquisitions came from Prologis. I mean, very high level institutional private equity experience on the leadership front. And that filters down in terms of investment rigor and decision making and how we operate both the real estate and the family office side of things.
Fascinating. And for those listeners who may be in the services side, whether it's investment banking, legal, consulting, tax, what have you, if you had to tease out the traits that the best, call it third party partners to you, advisors to you, have, particularly as it relates to family offices, what would you say you would put near the top of the list?
That's a great question. I think for me, the providers that I like working with the most have probably two key characteristics. First and foremost, like there has to be an interpersonal fit. We're spending a lot of time together. I like working with people who are really like kind, nice, thoughtful individuals. And then the second piece is knowing that it's their area of expertise and not mine. People who have the patience to explain things in a way that takes out the technical jargon, takes out and will continue explaining until I understand it. Like, I didn't understand that. Can you explain it again? Can you explain it again? Because I really want to be able to internalize all the stuff and learn from the providers that we're working with. I don't want you just to do a job. Part of your job is to teach me and get me up the learning curve.
Understood. And in terms of deal sourcing, let's maybe transition a little bit to, real, whether it's real estate or private equity. Would love to get the sense for where you are now and where you're going. But generally speaking, around deal sourcing, right? Can you talk a little bit about how you think about it, how you're going about it, and how you develop your funnel?
Yeah. So I think it's real estate is private equity is more kind of we're over allocated right now. So we haven't really been as active looking at deals, but B, it's more kind of who's in our network. On the real estate side of things, we're very because we're sponsors and we're raising outside capital and we have fiduciary responsibility to do so. We've built a pretty robust acquisitions funnel. And that starts with AI and using technology and using a really sophisticated technology stack to source deals and then move deals through our pipeline and execute business plans once they're in our pipeline and they're closed. And so we use a software called Prophetic AI. Um, and they mostly work with home builders, but we were early investors on the prop tech side of things. And um, we use that to find deals that fit in our buy box. And so for us right now, we're very focused on industrial outdoor storage. Those are contractor yards, anything to do with trucking, equipment rental, that kind of thing. So we're looking for in our sweet spots 5 to 20,000 square foot building with 2 to 6 acres of yard. We use their technology in our target markets to figure out a list of properties that fit that buy box that are not owned by institutions. And then we go through and we cold call. And we use outsourced labor, people who have downtime, extra time at our company. And it's pretty robust. And that gives us a pretty strong off-market deal flow in addition to working with local brokers and doing and like openly marketed deals and all that stuff. And then we're underwriting with pretty institutional rigor. We tie it up and then we'll go raise capital, move it through our deal pipeline, and then we're executing the business plan as quickly as possible. So that I don't know if that answered your question, but um and and then
Detail
on
is extremely helpful. Yeah.
and then on top of that, we're using AI at the deal funnels standpoint. We're using AI once we have deals tied up to track the progress on the business plan execution, interfacing with investor questions, all of that stuff. We have a pretty um, a custom technology stack that helps things move through the process. But I'm of the mentality that AI is a game changer for everyone, but it's really important for small to medium sized businesses like family offices to utilize. as we kind of I think we're at the beginning of an economic cycle right now, but I think there's a great opportunity for wealth generation in the next 5 years on the investing front. And I think family offices are pretty ripe to take advantage of that.
Yeah, no, I cannot agree more, and I firmly believe, we're in the precipice of family offices redefining, the roles of, various cap stacks from private equity, from venture, you name it, and I'm certainly, very, very, committed to that. Talk a little bit about, co-investment with other family offices, deal sourcing with other families. I know that you're very active in a variety of family office organizations, but could you talk a little bit about how you think institutionally partnerships among family offices can drive value?
I mean, I think it drives tremendous value. Just anecdotally, for we're only N of one, but we have families that invest with us who have particular expertises outside of real estate. And when we go and invest in whether it's tech or private equity, we lean on our network for diligence and for deal sourcing. And I think when you're talking about people who all have skin in the game, the the calculus is very different. Like, we put 10 to up to 30% of the equity in our deals, and then we're raising the rest from family and friends and other family offices. And if we're investing on the tech or private equity side with families who are doing the same, it gives a lot of comfort, and I think it allows us to build a super network of people who are really experts in their space.
Got it. Look, going back to one of the verticals where you have very deep domain expertise, outdoor storage. Maybe for the audience, tell us a little bit why you are very bullish on that vertical, and what are some of the macro opportunities you see that have caused you to really double down?
Awesome. So, I mean, when we come into new real estate theses, we're asset class agnostic within real estate. Like, I don't care if it's industrial or retail or multifamily. I want the place where I see the most alpha. And coming into a high interest rate environment, we want to be in a space where cash yield is where the cash on cash is very attractive, and you do not have to rely on interest rates going down. So right now we're at a very interesting point in the market where we're seeing spreads of 150 plus basis points, 200, sometimes 250 basis points between where the interest rate is and where our stabilized yield is once our business plan is executed. And so say interest rates are 5.5% for credit tenants right now. If you can get a credit tenant like an AT&T, we have a AT&T deal tied up right now, and the going in cap rate 7%, 150 basis point spread with AT&T as a tenant who's been there for over 20 years. Like, that feels really good right now. What makes me nervous is vanilla multifamily, where you've got less than a 50 basis point spread and you're using agency debt and pulling all the levers just to get the numbers to work. Um, that doesn't feel as good right now. It's all about like cash on cash and where we compare to alternatives, whether that's private credit, whether that's the public markets. We need to be generating returns, that are competitive in the asset class.
Right. Very insightful feedback. Now, as you look outside the storage vertical, what are the other subsectors that you find perhaps that if you're comfortable sharing, you're considering in the future, and what are some of the others that you're staying away from?
So I'll start with asset classes I like because I feel bad. I feel bad talking smack about the other asset classes. 'Cause I think there's a time and place for every asset
Sure.
class. But
Agreed.
right now, if we're saying this moment in time right now, I like, we've done self-storage in the past. I think self-storage is pretty fully priced right now. Um, we obviously like industrial outdoor storage. I like cold storage. There are a lot of storage niches that are attractive to me now. Um, Cold storage. I like manufactured housing outside of industrial. I really like manufactured housing. I think if we hadn't done iOS, manufactured housing was up there with the potential alternatives. It provides an affordable option for people who are living in really infill areas, and the bonus depreciation is great for real estate investors. It's I think it's probably number one out of any of the asset classes. You're getting in most cases over 100% bonus depreciation. So dollar for dollar, you invest a dollar, you're getting over a dollar of bonus depreciation in the first year. iOS is pretty decent depending on the asset. Like it ranges from probably 40% on the low end to up to over 100%. But manufactured housing is the king of bonus depreciation. Um, I like um, I like senior housing, but we've done senior housing. It's very operationally intense to do it yourself. Um, and I think it's just my background. For core, if I was an institution, I do like grocery anchored retail right now. It's just not like we're not interested in making core investments. We're much more focused on value add. And then everybody likes shallow bay industrial right now. On things I don't like, I'll give you a controversial opinion. I don't really love um biotech and data centers for similar reasons. It costs a lot more to build them out, and you're only getting incrementally more rent on the biotech side. And data centers, they're building them to like a 10% yield right now. And I think a lot of family offices are looking at data centers because there's so much buzz around it. They're building them to 10% yield, which means that it takes you 10% to get your money back if you're just looking at cash flow. So play that through. You build a data center in 10 years, Amazon decides that they want to pay you half the rent, or they're like, this technology is obsolete. We don't want to be here anymore. What are you going to do with that building? It's kind of scary. So we're shying away from data centers. I like the power and infrastructure plays around them, but data centers themselves are not an area that we'll be focusing on anytime soon.
No, yeah, very interesting insights. I know you're not allocating to PE right now. It sounds like you're pretty fully committed there, but within, I know you're always thinking about multiple asset classes, including PE. Is there anything outside of, call it a real estate infra vertical, that you are particularly bullish on, or if you did have the deployable capital, you would take a serious look at?
Within private equity, I mean, I like the lower middle market stuff, but I think everybody is trying to play in those spaces right now. Boring roll up businesses. I mean, I think that's the bulk of what I'm seeing in private equity on a deal flow perspective on our side of things.
So Christina, talk to us a little bit about sports media entertainment. That's been a lot of buzz around pro sports, around technology, hitting the entertainment vertical and integration. What's your view on that space?
So I had a feeling that this was going to come up, given that we've been consistent investors in sports for over 20 years now. I think valuations are pretty full right now, and we didn't come into this space treating it like a actual asset allocation. We probably should have. Um, I think there's a lot of opportunity to make money in sports right now. And the reason for that is it's essentially an anti AI play, right? Like there are only so many professional baseball teams. They're not making more of them, and you cannot manufacture a great baseball game. I mean, I think you can by cheating, but like in normal circumstances, it's true entertainment where we don't know the outcome, and that I think is going to continue to become more and more exciting over time, as AI fills in the gaps in many other parts of our lives. So I do buy it as a asset class right now. I think it's going to be interesting to see what happens to sports and media as more private equity comes into the space and there's more money chasing what's really truly a finite amount of assets.
Right. One other vertical I want to touch on briefly is healthcare. And you mentioned AI. You look at the incredible applications that you could see solving diseases that many people think were incurable. There's some amazing projects going on right now. Mark Cuban is backing a project called The Incredible Dream that is looking to solve ALS as the first of many diseases to tackle. Any macro views on healthcare and technology in that space?
I don't know a ton about healthcare. I am very personally interested in the longevity space and follow that from a health perspective. And I think these innovations are going on right now. It's like never been a more exciting time in human history to be alive in general. But we don't have a ton allocated to this space. Um, but definitely one that I follow from a
Yeah.
interest perspective. But from a family office investing perspective, if I was starting with a fresh allocation, I think it's a really interesting place to play because of that flexible time horizon. Like these guys cannot guarantee they're going to be through phase three testing in 5 years. It's just not going to happen for most of these investments. And so that whole period makes it a very interesting place for family offices to play.
Yeah, and I think particularly if you can diversify across a variety of different strategies within the, call it, wellness, longevity space, diversify your bets. There's going to be just some transformative things going on. I learned recently that for the first time ever, human liver cells have been reversed aged. So I didn't validate that independently, but I heard that from a credible source, which, if you think about that, if we could start reverse aging human liver cells, what's next?
I heard something similar that they not just liver cells, that they were doing it in animals, which I guess maybe liver cells was the after was the test for that. But yeah, I mean it's pretty crazy. I think we'll be the last generation of people that don't live consistently past 100. That that
Well, I'm not giving up on that yet, so we'll see.
I don't know. I think there's something good in the water that we're drinking. My 98-year-old grandmother lives with us, and knock on wood, she turns 99 in 12 days from now. So there's something in the water, and when we need us, that's
Well, no, I think, and clearly you come from good stock and healthy stock. Let's transition and talk a bit about California and geography in general, right? So you're obviously one of the prominent California-based family offices. You've invested very heavily in California, but not limited to that. Can you talk a little bit on your views of California versus Texas versus New York? Maybe your views on the United States, kind of where we stand as a country now relative to other locations around the world.
I'm still bullish on the US in general from a macro perspective. I just don't see other like safe places to put your capital. And the innovation happens here. And when I say here, I mean the United States, I also mean California. And so we've been consistently bullish on California, even as people have continued to leave. If you look at net migration numbers in the Bay Area, it turned to positive net migration immigration numbers like a few years ago. Like um, some of that is H-1B visa people moving in, but we're very bullish on California, partly because people are shying away from it right now, and I think there's a turning of the tide. But it's from a real estate perspective, it's difficult to get entitlements in California and stop. Like there's no and especially in the areas that we play in industrial, they are not zoning additional land for heavy industrial. We're looking at a deal that'll be closed by the time this podcast comes out, but it's in California in a tiny town. It's a big agriculture town, and it's 3.2% vacancy in the industrial submarket. I mean, there's nowhere there, the market is so tight, there's nowhere to go. And people are just still really shy to invest in California. What we're seeing is like people are coming back to the office. You have to be in the office whether it's 5 days a week or 3 days a week. If it's 3 days a week, you can't live in Nevada anymore, especially if your employer wants you on Monday, Wednesday, and Friday. Um, it's this is where the innovation is. This is where the companies are. We're very bullish on California still. Um, and I think it's for us, it's not just California, it's what submarkets in California. And we're very submarket specific. We always have been. And so we want to be in the best submarkets where the supply is tight. We know entitlements are tough. Um, and that drives real estate values up quite a bit over time. And so yeah, we like the Western US in general. California, we're targeting Reno, Las Vegas, parts of Phoenix we like, and then Laredo, Texas for the nearshoring. I live in San Diego, so we looked at our border first and we said too expensive. Where is there the most price to where is the most alpha if we look at all the border towns, and we ended up in Laredo, Texas. So that's what we're placing on border bet right now. But in general, Laredo, Texas is unique because in Texas they let you build whatever you want, but you have to be within certain proximity of the border to be relevant. And so it does still create barriers to entry, which we're excited about. But in general, the name of the game with California real estate is there's just barriers to entry. And that creates real value creation, especially over long periods of time, which that's the name of the game for us is long periods of time.
Amazing. Well, you've been incredible. You've shared so many amazing insights. Before you go, if there was one lesson that you could share, one of the things that we try to do on this podcast is make a difference and help, whether it's families, whether it's investee companies, whether it's advisors. But If there was one lesson, it could be from your family, it can be from your investment, it could be, whatever you like, that you would like to share to make a maybe leave a positive thought to make a difference in the lives of others. What would you say that would be?
I think the concept of stewardship is so relevant in the family office community. The number one thing for me is how do we keep that sense of stewardship alive from generation to generation? And that lies at the core of what a responsible family office does is it teaches stewardship from one generation to the next. And that's stewardship within the family for the family's wealth, but also in terms of being good stewards within our community. That to me has been my driving factor, my North Star for my whole career. And I hope that it inspires others to do the same.
Well, that is very inspirational, certainly to me. And I have no doubt people listening to this podcast will take that to heart and hopefully create a ripple effect that can make the world a better place, as your family has done now for 3 generations. So, thank you so very much for taking the time. You've been amazing. I really appreciate your insights today.
Awesome. Thank you so much for having me, Hendrik. I love the new podcast.
Thanks, Kristina.